will handle. All right.
Yes, I was muted, but they're all in now. Okay.
So hello, everybody. Good morning or good afternoon, wherever you are. So this is I'm pleased to introduce you to the last lecture in our series. It will be presented by Antoinette, and she'll talk about payment systems and cryptocurrencies. So Antoinette, the floor is yours. Thank you.
Great. Yeah, thank you very much to invite me, and also sorry to everyone that this was at a different time now than it was meant to be. Yeah, unfortunately, that was not in my control. But nevertheless, right, what I want to talk to you about today is indeed kind of a combination of work that I have done and other people have done to think about you know, how basically cryptocurrencies, and in particular proof of work cryptocurrencies like Bitcoin work, and maybe more importantly as economists, you know, what we should think about them in terms of their importance or interaction with the financial system, and in particular financial stability. So the roadmap for today is basically that I want to show you where basically do we stand currently in the ecosystem. In particular, I will focus on Bitcoin, but I'll start a bit broader to think about, you know, kind of the role of ledgers in general. And then I will show you what, as an economist or a financial economist, what can we learn from the transactions that are visible and that can be traced on the blockchain. And in particular, I want to argue that we can actually make progress in understanding what are the drivers of value and the use cases of cryptocurrencies. And then I want to finish, which is probably the more speculative part, on, you know, kind of what should we expect if there's wider adoption of the type of cryptocurrencies like Bitcoin, which are pseudonymous, which basically means that you can trace the flow of Bitcoin, but you might not be on the blockchain, but you might never be able to actually trace or know who are the people behind or the entities behind those addresses. But I come back to this in a second. And also let me remind you, you know, if you have comments, questions, you know, feel free to either raise your blue hand or, you know, kind of when there is a more or less a logical pause, you should also really feel free and unmute yourself and ask a question. Yeah. Okay, so just, you know, kind of as one little step back, right? The core issue, obviously, in payment systems is that, you know, the fundamental problem is that we want to have a record-keeping system that is trusted, and in particular, as say, for example, Abadi and Brunnemeyer point out in their 2018 paper, right? What we want is something that's correct, cost efficient, and ideally decentralized to avoid concentration of power, and with the concentration of power, maybe the ability to divert the integrity of the ledger, right? And what, for example, Brunnemeyer and Abadi and Brunnemeyer also point out that it's typically the case that you have what they like to call this blockchain trilemma, but in general, you have this quote unquote tension between how centralized the ledger is managed and, you know, kind of how much you can then decentralize the record keeping. And just, you know, to stay in, you know, kind of in the language of Abadi and Brunnemeyer, right? What they point out is that if you think about centralized ledgers or centralized payment systems, like say your credit card system or, you know, kind of a banking system, basically means that you leave rents to the central record keeper in order to give them incentives, basically continuation value or franchise value, in order to stay stay honest, right? And if you look at their helpful little graph here, right? Say a centralized ledger obviously dominates in terms of issues of resource efficiency and self-sufficiency, meaning no outside resources or outside trust has to be imposed or brought to the ledger. But it is true that if you can't trust your centralized record keeper, then of course this is a very problematic system. And then, you have basically what is called proof of work blockchain system like Bitcoin, where you have decentralized record keeping, but with the decentralized record keeping, meaning, right, that you have competition of miners that are competing for verifying any transaction on the blockchain. The issue there then, of course, is that you have compared to the centralized ledger, tremendous resource costs because it has to be expensive for any one miner to create enough capacity to reach 51%. Because as soon, this is the famous, right, 51 attack or potential 51 attack on any proof of work blockchain would be that one entity or set of miners have enough hashing power or basically verification power to fork the blockchain, or just think about it as being able to mess with the integrity of the ledger. And then there is so kind of up here, as I said, right, centralized ledger, think of it as your credit card system. Down here, basically proof of work blockchain is something like Bitcoin or Ethereum to some extent. And then you have what is called proof of stake, which kind of is basically an in-between between these two, because there you have a mining community that is not that's why proof of stake, right? That is not as set up as competitive in its verification process as proof of work, but there you have several entities that therefore have a stake in the continuation of this blockchain. Yeah, and so this is kind of where this whole debate about cryptocurrencies right now are, right? That say, if you are trusting in your government or your Federal Reserve System, etc., right? You might think that this type of centralized arrangement is the most efficient because it doesn't duplicate a lot of resources, kind of, and it's typically, correct and, and very, very convenient, right? But if you say are in pick your favorite non-functioning country, but let's say Venezuela, right? You might think about this very differently, right? And therefore, of course, the costs or the relative costs will also vary, right? If you are in a country where maybe regulation cannot keep the banking system honest, then you might really not like to have this centralized provision of the ledger or the payment system, right? So this is kind of, I encourage you kind of, if you want to read more about this, Marcus's paper is very, very nice and lays this out in more detail, but you basically, right, get the idea of what this debate is about. Now, kind of let's skip the little images, but kind of what I want to show you, right? And so, from over the last almost decade now, we have seen a proliferation of many different, by now thousands of different coins or different, kind of proposed new ledgers and currency systems. The most famous one still, and the most widely used, is Bitcoin. And as I said, right, this is this proof of work, very decentralized system. And so I will, in most of what I show you today, I will focus on Bitcoin as one example, but, happy to discuss other dimensions if you guys are interested. And, as we said, right, what is Bitcoin in the context of a payment system? It's a decentralized, or it's a protocol that supports a decentralized pseudo-anonymous cryptocurrency. Now, what's pseudo-anonymous? I'll show you this in 1 second. It basically means that I can trace any Bitcoin since its inception in, say, 2009, for example, and exactly which addresses, or think of it like accounts in our traditional payment system. So I can trace the flow through all these different addresses, but I might not know who the owner behind the entity is, right? Behind the addresses. So, kind of that's exactly the often touted basically anonymity, or, kind of attraction to people that basically like independence from the government. I want to, I will not talk about this too much today, and if any one of you is really interested in those type of issues of fraud and so on, I can point you to lots of literature. But one thing I want you to all just be clear in the back of your mind, recently, right, there were a number of ransom payments that supposedly the FBI caught, and they did in several cases, but it's not because they somehow cracked the Bitcoin ledger. What happened is that either they, for some reason, had the password of one of the participants in the ransom payment. So they basically just got an access to an account, and from it, access to other people in that network. But that didn't mean that they somehow invalidated the anonymity of the Bitcoin blockchain. Right? And in another case, actually, what they did is that it seems that they identified users of the ransom payment by actually controlling one of the servers through which the criminals actually were sending their money. So why this is important to me is basically to tell you that it is not the case that we or the FBI or whoever can currently identify people on the Bitcoin blockchain who know what they're doing and who do not want to be identified, right? So, and I'll show you more about this in detail, but I think this is important because especially even, on Bloomberg, you sometimes read this and it's just not right. So, as we already said, right, so Bitcoin is a publicly disclosed ledger of transactions that are stored in a blockchain. It's a proof of work system. And right now it is set up as what people like to call a scarce token economy, meaning that once 21 million Bitcoins will have been mined, meaning will have been issued, right, awarded to the miners, they will stop there. And then only these 21 million Bitcoin are supposed to be in circulation. Just as an aside, what does this mean actually for the transactions on the Bitcoin blockchain? If you think about it, right now, miners are awarded or rewarded the Bitcoins when they verify transactions or blocks on the blockchain. And of course, right now, Bitcoin is relatively valuable again, maybe not as much as even 2 months ago, but so this is actually right now, the miners are in some sense being subsidized, meaning the users of Bitcoin are being subsidized by the fact that there are still coins that are coming out. Once this stops, if it then stops and the the community doesn't decide to change the protocol, it means that subsidy is going to be gone, and then the users, the transaction users of Bitcoin will have to pay for the transactions with fees alone, right? And so this is something, if we have time at the end, we can speculate a bit. So this is kind of where we stand on this. Actually, if you are interested in thinking a bit more about, what are the incentives of miners in basically staying honest, if you want, or trying for 51% attack. Eric Budish has a very nice paper in 2008 that basically draws out some of the core economics of the mining community, and in particular, right, incentives to either sabotage the blockchain or maintain in a way, the integrity of the blockchain by mining in the intended way. Now, kind of at its heart, right, it's really a simple tension, right, which is how do we keep miners incentive compatible? I mean, how do we keep the incentives compatible with, kind of good behavior and not malfeasance? So basically, what makes the cost of the attack bigger than the benefits of the attack? And you could think, right, even here that the miners, that's also what, kind of Budish points out in his paper, right, is that the investment that many miners have to make in this mining technology is often not fungible. And so miners, despite being decentralized, have a continuation value, because if they were to attack the blockchain, they might actually, kind of lose the investment that they have made into the system. But it is true, and I want to come back to this when we think about regulation and the risks to society, right? You understand that all these type of incentives that are pointed out, even in this paper, are economic incentives. So as soon as we think there might be actors within the system that do not think about continuation value or incentives in a financial way, but right, you can think of state actors or even just random actors that have utility from disrupting the system, right? Then those type of calculations actually become very different. And those are exactly some of the concerns that regulators now have and should have when thinking about how to regulate that system. But, kind of this is just foreshadowing of where we're going. Okay, so, this is kind of some of the major participants, but let's think about then what are the drivers of value, and in some sense, what are the drivers of demand in a cryptocurrency like Bitcoin. So in particular, right, as usual, and this kind of, for example, Susan Athey even has a paper, and I should have put, kind of a reference to this, sorry, but, kind of in 2013, and Marcus, for example, in this paper by Marcus and Abadi, kind of basically people have pointed out, right, that number one, say a cryptocurrency like Bitcoin actually has no economic value in the sense of there's no cash flows that it's generating. So the only drivers of value have to be service flows or beliefs about adoption. And then the question is adoption of what, right? And so here, right, the discussion or the debate has actually progressed quite a bit over the last decade even, because early on, many people proposed that Bitcoin would replace typical payment mechanisms like our MasterCard system or whatever, our credit card system or Venmo or PayPal and so on. And I will show you, I don't think anyone who is semi-intelligent still believes that, including all the entities like PayPal, for example, that are now engaging in or allowing people to trade in cryptocurrencies. And the reasons, as I will show you, is just the transaction cost and the speed of settlement by definition is just too slow. But where at the moment the big debate is whether cryptocurrencies, basically the service flows will come from being a store of value or purely a speculative asset. And this is something where I want to spend quite a bit of time to show you at least what we know right now about the uses of cryptocurrencies, like Bitcoin in particular, and also what we have seen about the trading of these cryptocurrencies that, just to not leave you in suspense, but I personally think that at best, a cryptocurrency like Bitcoin will always be a speculative asset. And from what you can see, and I'm going to go there now, it's very difficult to believe that it's a viable and even desirable store of value. Now, the same might not be true, and we can talk about this at the end, with some of the newer cryptocurrencies, maybe even Ethereum, or at least Ethereum-like cryptocurrencies that allow for the writing of smart contracts on the blockchain, because that obviously can have, quote unquote, true economic added value beyond just being a restricted token that can circulate, which is basically what Bitcoin is. Yeah, but I promise you I get back to this after I'll show you some of basically the statistical properties of Bitcoin returns. Yeah. All right, so just, very quickly, I'm sure many of you have seen this, but just, kind of to remind you, why would, in particular, Bitcoin not work as a payment mechanism? So number one is just resource inefficiency, right? Remember the nice little triangle from Abadi and Brunnermeier, but what you can already see is even at this stage where, yes, right, the total cryptocurrency market is around, kind of $2 trillion in valuation right now. But what, what you can see, right, I mean, it's a minuscule amount of transactions that are flowing, say, through Bitcoin, but even at this point, actually the annualized usage of energy in cryptocurrencies would place it somewhere, in terms of its energy consumption level between a country like Malaysia and Egypt, right? I mean, it's just extremely expensive in comparison to, say, a centralized ledger like a credit card system, right? And then on top of it, actually say, this Cambridge Center for Alternative Assets points actually out that on top of it, it seems to be even non-linear. So, when there's particular demands on the blockchain, the use of energy really scales non-linearly with it. So if you, yes, there have been recently some actually embarrassingly not smart papers written by people who have a stake in Bitcoin, like Dorsey and Kathy Woods and these type of people, somehow claiming that the excessive use of energy through cryptocurrency will stimulate more development of clean energy. I don't think we need more incentives. We need more a solution, right? So it's like a bit circular argument, right? So this is one argument, but there's another argument why it just would never work as a payment system, is that by its very design, the median transformation time on the blockchain, right? If you look, is around 10 minutes. So every block takes about 10 minutes to verify. And in times when the price particularly, right, goes up, for example, so, this is like end of 2018 or, kind of beginning of 2021, right? You see it even more than doubles. So this would basically mean when you want to use, if you ever wanted to use Bitcoin at your corner grocery store to buy something, you would have to wait up to 25 minutes before they can be sure that your payment actually is your payment, right? This is just nonsense. So that obviously doesn't work. So, we can rule that out. So let's turn to the more interesting part, which is, kind of what can we say about Bitcoin as a store of value? And here I want to share with you some work that I'm doing, and that is literally at the moment, kind of work in progress, where I want to show you what one can infer about the usage of Bitcoin from tracing transactions across addresses and across wallets. So what we do in, kind of, this is joint work with my co-author Igor Makarov, at LSE, what we did is we inverted the entire Bitcoin blockchain, and instead of having, because the way it is stored publicly on, on the public ledger is in terms of blocks, which for an economist is obviously useless, but we can invert it into transactions from one given address to another address. So just to give you, let me, give you a sense of what I mean, right? A transaction on the public ledger would look something like this, right? So this is basically, people also like to call this a digital footprint on the blockchain, but this is basically telling you where did Bitcoin come from, and this is, say, an address, where it came from and how much flew or went to different type of addresses, right? And so you can know exactly from what address to what address did something go, and I can obviously then also see that one address, right, sends to another address, and so on and so on. The difficulty that we spend a huge amount of time on top of, tracing these guys, is to identify who is who. And as I told you before, identifying participants is typically not possible if the user doesn't want to be identified. Now, what, however, is helpful, and that's kind of where we spent a lot of effort on, is that there are users who want to be public. So, for example, many large exchanges like Coinbase, Gemini, Kraken, Binance, and so on, we know, say, the address of their cold wallet. Why? Because, first of all, you can buy, right, Bitcoin on Binance, for example, and then you would know as a user what is the address of their cold wallet. And many people have done this and posted it on places like GitHub and so on, right? So, we collected those type of addresses. And then because in computer science, people have created clustering algorithms that allow us to cluster the use of individual addresses into wallets. And wallets means basically a cluster of addresses that has to be controlled by the same entity, meaning the same entity has the password to that wallet, right? Because those type of addresses have been used together in transactions. So from this, we are, say, able to trace exchanges, payment processors, fiduciary wallet providers, OTC brokers, like Circle, for example, right? Zapo, these kind of guys. So we can identify basically those entities. The other thing that we have done, and I'll show you the results in a second, is because from the known exchanges, we now see how exchanges behave on the blockchain, right? How much volume they generate, what type of volume, who transacts with them. This gives us an opportunity also to identify less well-known exchanges where maybe we don't even have a name for them, but where we can classify them as likely exchanges. And as you will see, why I'm going on about exchanges is that actually the majority of utilization of BTC right now is literally for exchange-related transactions, but not for any payment and other transactions. Now, so that's exchanges, payment processes, and so on. And I should say, actually, miners, in particular mining pools, we can also identify very well the mining pools, because typically, remember I told you mining pools, miners receive the original BTC as reward for their mining. And what typically mining pools do is that they sign the first bit, right? This is the initiate, it's also called the Coinbase reward, right? Kind of this initial coin they get with, quote unquote, the name of the miner. In fact, most mining pools like to do this because they want to show how much volume, and with it how much cloud they have. And so we actually have very good coverage of the mining pools. And then I'll show you, we're tracing mining pools down to miners. And then the other thing that we spent a lot of time on, and I'll show you some of this, is basically how much BTC is held by the largest investors, or crypto enthusiasts like to call them hodlers, which is just because early on, some people basically said they wanted to say they will hold Bitcoin to eternity, but they spelled it wrong. And so since then, this is basically, in crypto parlance, the largest owners or holders of cryptocurrencies are called hodlers. And I'll show you basically what we can know about them. And I'll also show you how concentrated to this day the ownership of cryptocurrencies still is on the blockchain. Okay. All right. So I think we said this already, but just to be very clear, right? What maybe in your typical payment system is an account, in cryptocurrencies is called an address. And those addresses are set up freely, or can be set up freely on the blockchain without any cost. In fact, it is so ubiquitous, these type of addresses, right, that typically a given user has hundreds, if not thousands, of addresses that are clustered together in what is called a wallet. And the reason is a bit technical and maybe boring for you, but the reason is basically that because on the blockchain, Bitcoins are traced, and it's easier to trace them in the original amounts that they were transacted on. That's why basically people actually carry forward lots and lots of different addresses. And when they want to make say, a transaction of 3 Bitcoin, right, they might take 1 from one address, 1.5 from another address that they got, kind of at a different point in time, and then the rest from even another one, and then those one are pulled together and then sent to, say, whoever the merchant is or the exchange that you wanted to send your 3 Bitcoins to, right? And so you see, from this type of idea or this type of transaction, in computer science, people have built clustering algorithms that basically trace which type of addresses need to belong to the same wallet because they have been used in joint transactions. And we can use exactly that as well to cluster addresses into wallets. And wallets here means, kind of pools of money controlled by the same controlled by the same entity. But let me also again point out that if you want to stay, or if you want to hide how much cryptocurrency you control as an individual owner, you don't have to transact your different addresses within the same transactions ever. And so it is actually everything I will be showing you. And in fact, there are lots of chat rooms devoted to the idea that there are lots of people who are actually trying to hide how much they actually control or how much they hold, and therefore, right, are never transacting in a way that any outsider could see that this is controlled by the same entity, right? And so therefore anything that I will show you or anyone else can show you on, kind of the blockchain is always a lower bound for the amount of either ownership concentration or concentration of volume that actually exists.
Antoinette, I have a clarifying question just to understand what you can trace and not trace. So as an example, right, Colonial Pipeline was hacked by dark side, and so they paid them whatever $4 million or something like that, right? And so then the API, I think, recovered most of it.
Yep.
So we have basically transactions. So initiation, we know where it's coming from, right? Because
Correct.
that's the Colonial paying them,
right?
And so then we can trace, right? So we can trace each individual. So for example, if they start splitting payments,
Yep.
right, we can trace all of that.
Yep, exactly.
But then when do we start losing information? We just don't know. Yeah.
Very good, right? So this is exactly right. So you basically lose information as soon as true information, as soon as a BTC leaves a cluster that you cannot tie to the previous cluster, right? Because say, you know, kind of this is maybe not the best. This is now, I wanted to show you spurious information, so ignore the gray right now. But imagine, right, this was, you know, kind of the original address that received a ransom payment, yeah? And now imagine that through other transactions that this address has made, I know that it is controlling all these other addresses, right? So even if then the BTC from the ransom payment goes all the way, say, forget A here, but let's say it even goes to D, right? I would still say it is staying within the same wallet of the same user and hasn't left them yet, yeah? Now, imagine, however, now it goes to an address, I don't know, call it, so I didn't put this here, sorry, but right, imagine it goes to another address that I cannot verifiably tie back to this cluster because maybe that address has never transacted with anyone, yeah? In that moment, I don't know if that address is now controlled by the guys who originally received the ransom payment, or if this is somebody who, some third party, right, who's willing to accept that payment, maybe in return for some physical delivery of money or something else, right? And so basically I will, because we want to be as conservative as possible, I will always stop what I call volume, right, between wallets, when I cannot with certainty make sure that this belongs to the original wallet, yeah? So in other words of saying, another way of saying this is that I will understate the concentration, because, you know, imagine there's a wallet E here, sorry, an address E that actually is also controlled by these guys, but I can't identify it. Then I would not pool them all together and say, this is one owner, and therefore look how much is concentrated in this, right? Nor would I, you know, kind of, sorry, in addition, any type of volume that is generated by sending from one identified wallet to another wallet or address, I call actually true transaction volume, yeah? And that's actually something, so let me come to this before I show you some results. That's extremely important because that's something we realized people hadn't understood before. And it has a lot of implications because, so let me now truly come back to what I wanted to show you. By the nature of how the Bitcoin blockchain works, there is a huge amount of what we call spurious volume, or call it pass-through volume. It's basically volume that is generated by people rearranging Bitcoins within their own wallets. So for example, and this happens all the time, and it's not that actually the way it works is not that you sit there and you do that, but wallets are controlled by software that kind of re-optimizes and rearranges your Bitcoins within your wallet. But on the blockchain, that is because whenever a Bitcoin flows from one address to another, it is traced, or it is calculated as a transaction. And so think about this type of situation. This is a situation where, say, we know that all these different addresses, A, B, C, D, and then P1 and P2, belong to the same user. We know this because in past transactions, these addresses have been used together to either pay for something or receive money, etc. Yeah, I mean, receive Bitcoin. Now, and this is kind of what the clustering algorithm does that we are using, and, you know, we've tried different ones, but, you know, then there's a main clustering algorithm that computer scientists have used. Now, However, there is very often, right, basically Bitcoin flowing from, say, this address through some pass-through addresses, and is then stored in other addresses related to that particular user, and might even go back to the original A address. Literally just think of it as convenience rearranging. It's like you taking cash from your left pocket to your right pocket, then thinking about the fact that you need to give your child some money, so you put it somewhere else, and then you forget it, you take, I mean, it's literally, think of it this way. But all that nonsense is actually recorded also on the blockchain. And now I'll show you why this is so important. On top of it is also the case, as I showed you, right? Very often what typically happens in any Bitcoin transaction is that if I send money to Alexei and say, I owe him half a Bitcoin, but I only have an address that has 1 Bitcoin in it, what would happen is that I send him 1 Bitcoin, half is split into his address, half goes back to a new address that belongs to me. Rather than just half is being taken out of my address and sent to him. But you can see from this, there's a huge amount of volume generated that might look like economically meaningful volume, that however is not. And what we did here by tracing all these things very carefully through the blockchain is basically that you can see almost 90% of monthly or daily or whatever you want annual volume is actually pass-through volume and economically not real volume. And I will show you in a second why this is so important, because it not only does it mean that, you know, kind of we're overstating how much actually Bitcoin is used for real transaction, it really matters when we think about illegal transaction, because what I will show you is that in particular for illegal transaction, a lot of spurious volume is generated. And so people actually overstate. This is one of the reasons why people have overstated how much illegal transaction volume there is on the blockchain. Okay, so once you strip out all this kind of spurious or pass-through volume, what actually, this comes now back to what Mike was asking before, what is actually going on? What is the actual meaningful economic transactions that are being generated on the blockchain? And here, in order to be really conservative and not overstate volume, we do exactly what we discussed with Mike, which is I only look at Bitcoins flowing to identified addresses or clusters that I can identify. And I break this out into these different main participants on the blockchain. So the dark blue line down here, or whatever, purplish, you know, kind of bin, is basically volume generated by money flowing to exchanges. Okay, so this is if Mike wants to trade on Coinbase, Coinbase, or, you know, kind of say Binance, and sends 3 Bitcoin to his Binance account, that is what would be traced here. What would not be traced, and I can show you some of those results later, is say any volume generated on Binance as trading volume actually does not get reported on the blockchain. Why? Because actually, as a user, when you trade on an exchange, you are forfeiting. You're literally sending your Bitcoin to the cold wallet and then the hot wallet. Hot is the wallet that actually makes the book, right? Where the trading happens. Cold are the wallets where the exchanges typically store your Bitcoin so that they don't get hacked and they don't lose them. But you are literally sending your Bitcoins to the exchange, and then you have to trust again that the exchange holds a trustworthy and well-governed or well-monitored ledger centrally, and it goes all off the blockchain. Yeah, so this is just to say that all the people who are such strong believers in, kind of cryptocurrencies, especially Bitcoin, they do have to trust some entities insanely, right? Because if Binance decided to run away with all this Bitcoin, right, then there would be no way for them to have any recourse, nor even, kind of a trace of what they had sent to them. Because remember, you could even show that you sent something to them, but you wouldn't be able to prove that it hadn't been sent to you back if they don't want to. Yeah, so this is actually important, but it just means you should think of this as the volume of money that is being received or sent to exchanges. And this is kind of weekly averages that we calculate here. So this is about, and I should also say, it can be from individual addresses, it can be from other known exchanges, for example. So on a weekly basis, Binance and Kraken and, kind of Huobi and so on, they send actually a lot of Bitcoin to each other. Partially because, right, they are probably sending on behalf of their clients. Some of it might also they themselves actually, sending, kind of out of their exchange. Now, that's about 40%, even starting in 2015 all the way till today. Now, the bluish line, I broke this out for you. We call them likely exchanges and over-the-counter brokers. Those are basically, think of those as the OTC brokers like the Circles, Grayscale, basically intermediaries that are not per se exchanges, but that are interacting with exchanges and that, kind of, again, are allowing individuals to generate liquidity or for their Bitcoin and exchange them, if they so want, right, into fiat currency or other tokens. And as I told you with the exchanges, I can always only trace the money to the doorstep, if you want, of these entities, because once they reach this entity, whatever goes on within this entity, I don't see anymore because it is kept track of on a completely different ledger. Yeah. Now, then the lightish blue line, right, that you see here, lightish green line that you see here, that's the volume generated from miners. And you can see how tiny that is. Same thing. So, why do miners generate volume? Well, right, remember, I told you they receive the Bitcoin through the mining, and then typically many of them actually cash out relatively regularly, especially on exchanges, but they also send it, say, to payment processors and others, right? But you can see, right, this is kind of less than 2% of volume, weekly average volume. Interestingly, right, if you look, right, even illegal and identified illegal transactions and known scams, and when I say illegal, I mean with this also ransom payments, things like darknet, like purchases on Hydra network. I will get there in more detail in a second, right? All these type of things, and we include even mixers. Mixers are these type of entities where people deliberately send their Bitcoins so that they get mixed with other people, and therefore you lose track of how much an individual had sent there. And when it gets sent out of the mixer, right, new addresses are generated. And because new addresses are generated, you don't know who owns them, right? So many regulators and even the FBI have been trying to kind of crack down on mixers because it's been a nice way of hiding who you are and trying to hide, or obfuscate, especially illegal transactions. But you see, the reason why I'm going on and on about is you can see how little volume that actually is in terms of transaction volume on a average basis. And then what is the rest here? So basically the darkish line here are transactions that are between individuals that, where we do not know who they are and we cannot trace them. But the orange and I don't know, whatever, light red red bar, is volume that comes from exchanges to others, right? Meaning, basically think of it mainly as money that is being paid out from exchanges, mostly to individuals. Why I broke this out, and you understand, right? This is not double counting, because this is volume to the exchanges. This is volume to others, but this part of it is the volume to others that I know comes from the exchange. And the reason why I wanted to show you this is because if you look at the proportions or the magnitudes, right, it's almost 80% of average volume on the blockchain is purely exchange related. So it's all trading and basically intermediary related. It's not for transaction. It's not even for illegal transactions, because illegal, right, makes up a tiny fraction of these transactions. So the reason why I'm going on and on about this is the following. It's not because I think illegal transactions don't matter. Actually, I think they matter big time. And I will show you in a second actually how they get sent around on the blockchain. So I'm not trying to downplay the importance or maybe the risk that, you know, for public welfare from having a system that allows, you know, kind of this utilization of illegal transactions. But if you think about the value of Bitcoin, right, it's very tough to see that the value of BTC right now is supported by demand for illegal transactions, given how tiny that fraction is, and given that the vast majority of what's going on is basically trading on exchanges. Yeah. So I think, you know, we were actually very stunned when we saw how little, number one, transactions per se make up, I mean, non-exchange related transaction make up on the blockchain, and then also these illegal things. Let me say, you know, kind of those of you who have followed maybe the Bitcoin.
Antoinette, sorry.
Yeah, go
sorry,
ahead.
There are a couple of questions.
Go ahead.
For you. Anne, please go ahead and ask your question.
Hi, thank you so much. I just wanted to ask you to expand your definition about what you consider an illicit or an illegal trade. Because is it just someone trading in narcotics or other products, or is it people? I mean, could something like tax evasion or money laundering fall into those other larger categories and we just don't see it? Because I think that's a huge problem, right?
Absolutely. So very, very good question. So I should have been clearer. So what I call here illegal is a very narrow definition of illegal. It's literally, you know, ransom, you know, kind of, you know, remember what Mike was asking before, addresses that we known ransom payments or known transactions on, say, Silk Road or Hydra Market, which is basically, you know, kind of now the biggest, you know, darknet exchange. But there are many of these darknet exchanges where we know, for example, drugs, you know, guns and other things get traded. And so when I can tie, or the FBI or I mean other entities have done this, you know, an address to one of those activities, that's what I call illegal. What I do not call illegal right now is, say, tax evasion. In fact, and I promise you, because I do believe this is a huge problem, most of what's going on in this volume is probably affected by tax evasion. And the reason is, and I will show you this, is because right now the exchanges are doing minimal KYC enforcement. Even the ones that are trying to do KYC enforcement actually do not find it easy. And let me show you now how I know this, and that will hopefully answer your question in more detail. Yeah? Fair?
Yes, thank you. Thank you.
Absolutely.
So there is one more question. I apologize if I mispronounce the name, Roji.
Yes, it is. Thank you. So my question is similar. Basically, how do you identify an illegal transaction or scam? You said that the illegal, you have, you know, the illegal address. those known addresses. But is it possible that there may be a downward bias? Say only a small portion of illegal addresses are known, but there are some others that are not known. Thank you.
Yeah, absolutely. So very good question, right? You're right. It's somewhat related to Anne, but remember, because we want to be as quote unquote conservative as possible in what we attribute to a given usage, right? So the way, if you think about I identify any volume here is by the type of address that it flows through. So, right, remember, this is volume flowing to exchanges, volume flowing, kind of to miners, volume flowing to these known illegal addresses, meaning, kind of say an address that either by the FBI, by places like Coin Analytics, Crystal Blockchain, kind of, we work with, all these basically providers in identifying addresses. And, this is boring, and that's why I didn't want to spend so much time, right? But this is where we spent huge amount of time over the last 2 years to identify these addresses, right? So this is basically volume flowing to known illegal addresses. You're totally right, Rushi, that this is most likely an understatement, but I know how big the understatement can maximum be, because it can be, at max, it can be this. And in fact, it cannot, I'll show you in a second that it cannot be this red bar, because within this, what I here call other, I can identify individual large traders that are not illegal, at least not in the narrow sense of criminal, right? They might be tax evading, but they are not known to be using them for those obvious criminal purposes. Yeah. Now, I promise you, in a second, you might, kind of, there are some papers that have said that the volume of illegal transactions on the blockchain in Bitcoin are more than 40%. And I'll show you where the difference between us and them comes from. But before I show you this, I want you to understand something in a bit more detail, because then we can talk about this more smartly. So let me just show you what we can obviously do is not just to look at where the volume flows, sorry, but also basically how the Bitcoin network looks and who are the major entities on the Bitcoin network. And so what we do here, this is just, simple, basically graphing of transaction flows. What I do here for you is I'm basically showing you the network of the largest entities on the blockchain, okay? So I'm starting with only addresses that have transacted in more than 10,000 BTC ever, because otherwise what I would have to show you like a crazy amount of connections, right? But the thing that I find extremely interesting is if you look at the largest entities, kind of, you see, even just by staring at them, right? We get something like 23 entities that among them have 492 links. In fact, they are almost a complete graph, right? Almost any one of them links literally to the other one back. But interestingly, and maybe not so surprising after what I showed you before, 18 out of these 23 are exchanges, identified exchanges. So you see like Coinbase, Bitflyer, Gemini, BitHump, right? Upbeat, Binance, Bitfinex. If you know Bitcoin, right, you obviously know those names. Then you have 3 that are basically online wallets, in particular BitGo, right, somewhere here, and Zappo. And then there are basically 2 entities left, which I put here as the beginning of their address. And so they are unidentified, even with all the effort we put in to identify, kind of, in particular, the largest addresses. We don't know who they are, but from the way they behave, meaning how much volume they generate and how much they interact with other known exchanges, most likely they are either OTC brokers or small exchanges, right? This is just, again, to show you how central exchanges are as a connection hubs and how interconnected they are on the blockchain. Now, I can show you this a little bit more formally if you want, but it basically does the same thing, right? So we basically show you that the top 25 entities within, sorry, with the largest BTC network centrality are those guys. And again, right, they are exchanges. So, you know, this is kind of typical in network analysis, right? What we use is eigenvalue centrality for an entity that we identify here is basically defined as the volume of BTC flows between addresses. Yeah, so this is eigenvalue centrality based on flows. I can do the same thing just on the number of transactions, not the size of the transaction, and you get a very, very similar picture, right? But what you see again is even in this slightly more formal analysis of connectedness and who is central, you see again, it's the large exchanges that, you know, kind of by really, you know, kind of an important margin outdo everyone else, right? So Binance, Coinbase, will be all the names that you know. Yeah. Now, given that I can trace these flows across addresses, let me show you one thing that actually we were really impressed by, not with ourselves, but actually how nice it works. And this is to come back to, you know, what is illegal and how should we trace illegal flows. And so what I'm going to show you is one example of an illegal flow, just to give you a sense of how complicated it will be for regulators to actually enforce KYC norms or even just basic standards of legality on this in this network. So what I'm doing here is I'm using Hydra Market. Hydra Market is at this point the largest darknet market. You know, it used to be Silk Road in 2015, but right, they got shut down famously and all this, but Hydra Market is still up and running and doing very well, unfortunately. So it's been in existence for more than 5 years, but I just wanted to show you as of today, if you want. So flows from 2020 and 2021, during that time period, they received 147,000 and a little bit of Bitcoins, right? So multiply this by 50,000 or something. So this is not trivial amounts of volume. And there are about 514,000 clusters that interact with this Hydra market. Yeah, so those, but that's important, right? So those are people that either are buying or selling on the Hydra market, something, we don't know what, obviously, right? We just know that they are sending to addresses that belong to Hydra market or are receiving from addresses from Hydra market. Yeah. Now, what I want to show you is, if you think about the regulatory challenge of how you trace, you know, kind of these illegal flows. So let me show you the picture, and then I can talk about this, right? So what I drew for you here are the flows between Hydra market, this is here, yeah, and other known and unidentified addresses, clusters, yeah. And the orange ones are the ones where I have names, and then some of the red, turquoise one are unidentified. On top of it, I should say, I only kept for you wallets that have received more than 1,000 BTC over the entire time period. The reason is because, again, I wanted to not have like a massive network when nobody can even think of anything, right? And then, as usual, the size of the bin here, of the node, basically is the size of the, you know, participation in the network. And, you know, kind of the link or the edge, as they like to call it, right, is basically how much flows back and forth. Yeah. But let me show you, kind of, which I think is really interesting. What you see is that direct flows from Hydra market to out of Hydra market is particularly to exchanges that do not even try to put KYC norms. So it's known that, say, local Bitcoin, Bitslato, Total Coin, these guys are not even trying, right? I mean, in fact, that's part of their appeal, that they're not imposing any KYC norms. Now, exchanges like Huobi or Coinbase or Gemini, right, here, are, of course, especially over the last couple of years when they wanted to be better regulated, have imposed some KYC norms. But think back to also what Anne was asking before, right? How do you impose KYC norms in this network? Right now, what they do is they impose KYC norms only on the last link that they see. So if I come to Binance, forget Binance, they don't impose, to Coinbase, they will say, okay, you are Antoinette Schoar, and this is your social security number, and blah, blah, blah. But if I am willing to interact with someone on Hydra market through their turquoise 9 here, they would not catch it, right? And so in that sense, I would be, any one of us could very easily become a dealer or a gateway of illegal crap into even the KYC imposing exchanges. And of course, like in many illegal networks, right, if there were some people who are willing, either against cash or other payments, to actually facilitate the flow of illegal BTC to what looks like legal addresses, or at least untainted addresses, and then into, say, the likes of Coinbase and so on, right, then this kind of tainted BTC flows immediately back into the network. And remember, so I want to just be very clear, how can I can know this because I can see this. So can the FBI, so can the IRS if they wanted. But think about what they would have to do. They would have to say, they would have to monitor that you, Antoinette Schoar, received maybe half your Bitcoin from addresses that we don't know who they are. And therefore, we don't know if they paid taxes on that Bitcoin, if it was obtained from an illegal source, blue, 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 and blah, 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 right? So what that means is that in order to do true KYC, it's not enough that I monitor the last link, because nobody has monitored any of the links before. So in fact, what I would need to do is I have to, sorry, I'm always saying Binance, even though Binance is not doing any KYC. So if Coinbase was trying to truly do KYC, it would have to literally trace back any Bitcoin that it receives to the last time that it was basically a clean transaction, right? Not just to me, but to any transaction in between, to make sure that in any transaction before, taxes have been paid on capital gains, that it didn't come from Hydra market, etc. And of course, right, it would be impossible for Coinbase to do this. In fact, it would probably, or Gemini, it would probably legally not even be possible for them. So it means that in order to really enforce KYC, we need to go back to a world that is the type of world we know in our banking system, or kind of credit card system, where actually, given that every link is supposed to be a regulated and known link, right, those type of things don't happen in those links. But you see, this is kind of a fundamental tension of being pseudonymous and being regulated. That's very difficult. And I can tell you, if you look at the paper, you will see actually the interesting thing that we see even with Hydra market is that, as I told you, those type of exchanges that don't even give a crap, right? These are the ones where we see lots of volume from Hydra market related addresses cashing out their Bitcoin. So the Bitslato, Binance, Huobi, and so on. in the places like Coinbase and Gemini, for example, that have for the last at least year and a half tried to do much better KYC norms, right? We see that the direct interaction with Hydra market is limited, but the indirect one is still very high. So exactly the thing that once somebody gets their money out of Bitslato and then goes to, you know, Coinbase, we see a lot of that volume flowing, right? And so, you know, that basically tells you, sorry, you know, kind of the difficulty that that regulators will be facing if they want to do a good job. Right now, it seems almost they don't want to do a good job, but that is kind of not good for all of us. But we'll talk about this at the end. I just want to show you one other thing, and maybe then it's a good time to take a break. But I want to show you one thing. So those of you who have, for example, seen, you know, kind of there are some papers in the RFS, for example, that have said that more than 40% of Bitcoin volume is illegal. So the reason why they find such a high amount and we find, remember, such a tiny amount is twofold. One is just definition. So what those papers do is they actually throw out any transaction volume that is exchange related. And they kind of only keep the small fraction of volume that is potentially transactions. Yeah. So basically, you know, the majority of what I've been showing you here, they throw out. That's fine, right? That's a choice. You can say, I don't want to right now look at the exchange related volume, so let me throw this out. No problem there. But there is another problem that previous papers have not done correctly, and that's related to the spurious volume and basically the interconnectedness that you hopefully now understand. Because if you are not correctly, so let me come here just to give you one example, right? If you're not correctly identifying what is an address that belongs to an exchange, maybe say belongs to a Bitslato, and what is an address that's literally a standalone illegal transaction, you will very quickly overestimate the illegal volume. Because if you don't know that this big amount of transaction is not all Hydra market, it's people who try to cash out, say on local Bitcoin or Bitslato or Total Coin, and they are mixing it with some legal transaction too, right? Not everybody who transacts on any of those type of things is illegal. Same thing with Binance, right? We think nowadays a lot of stuff goes through Binance. After all, it's the largest and deepest exchange now, and they don't have KYC norms, right? But you can't say that all the volume on Binance is illegal, of course not. And so what these previous papers did is they have basically this double problem or this double difference to what we are doing. One is not a problem, right? You can throw out the exchange related volume, and then the volume on illegal transaction will be a bigger proportion of what's left. But what I just showed you is a much bigger problem, because basically because they were not able to fully trace the interconnectedness of different addresses, they overestimate how much volume actually is generated through illegal, right? And so, as you see, it is much less than what has previously been done. And again, right, let me also be one more time extremely careful in saying, I'm not trying to say that this is not a problem. I'm just trying to say that the relative magnitude of the illegal demand is just not large enough to support the current value of a cryptocurrency like Bitcoin, given that it's less than 1% of its volume, right? I mean, that would be I'm sure you can write a theory to support anything, but I think it would be a very difficult, common sense stretch to do that. Yeah. So let me then, kind of this basically tells you where, kind of the current transaction volumes come from. And then, right, in the next part of my talk, I want to now think about what do we know about the trading of Bitcoin, in particular, right? How much? What do we know about statistical properties of Bitcoin? You know, can it be a good store of value, or should we think of it as a speculative asset? And in particular, you know, I will first show you a summary of some of the literature that has looked at the statistical properties of Bitcoin returns on the exchanges, which actually should make you very suspicious about it being a good store of value. And then I'll show you, again, using kind of my data from the blockchain, where I think some of the biggest systemic risks of Bitcoin are actually embedded. So in the next 15 minutes before we take a break, let me just quickly show you a summary of some of the things that people have done on basically Bitcoin returns. So let me start actually with the second point here, because, you know, I'm sure you're all very well aware of it and it's been, you know, discussed widely. But if you look, right, one thing that's actually quite surprising is that Bitcoin volatility has stayed almost unchanged from, you know, almost its inception, but let's say from 2014 all the way till today. And this is true despite the fact that the market capitalization of Bitcoin has gone up by more than 10 times in this time period, right? So typically when markets or asset classes in quotation marks mature, you might actually have much less volatility at some point, right? I know this is a gross generalization, but it has still stayed very high. One reason why the volatility probably is so high is that price impact of order flow is also still very, very high. You know, kind of so in an earlier paper that I have with Igor Makarov in the JFE, we, for example, show that even in, you know, kind of say 2018, 2019, you can see that the price pressure from a net buy order of, say, 3,000 Bitcoin, which at the time was $100 million, right, leads to 1% price increase. And I should be clear, this is a 1% systematic price impact across all the different exchanges in which Bitcoin is traded. Because Bitcoin, different from most other securities, or whatever you want to call Bitcoin, right, is traded on many independent and non-integrated exchanges across the world, right? Exactly the Binance and Kraken and Coinbase that we've been talking about, right? And despite this kind of decentralization or segregation, right, you still have actually massive price impact. And I'll show you why this is actually, we should all be concerned about this type of price impact, is because I will show you how concentrated the ownership of Bitcoin still is. So it's very easy for some large owners or hodlers to create massive disruptions in the price if they so choose. Now, of course, we have on top of it seen that some people can just tweet and create massive price disruptions, but, you know, kind of that's a separate story. So let me not bore you. You know, if you want to look at how we estimate price impact and the price impact itself, you can look at our JFE paper. But the other thing I want to talk about, I just want to remind you of, is that, again, actually over the last 5 years, initially there were a number of papers. Actually, where did my site go? Here, yeah. So, for example, by Liu and Chevinsky in 2018, that had suggested, or that showed that early on, Bitcoin returns were not correlated with any other risk factors that we know. So it was, you know, kind of uncorrelated with the market factor, with small, you know, SMB, HML, not momentum factor. It was not correlated with either, you know, returns on other commodities like gold, platinum, silver, etc. It looked like it was completely unrelated, with any other fundamental risks in the economy. And that actually some people felt was very attractive, because if it was to stay this way or were to stay this way, right, maybe it could have been a good hedge. Now, that is not the case anymore. So there are a number of papers. I just picked one that State Street released recently. But over the last year and a half, you can see that that correlation structure has changed. So Bitcoin returns are now much more correlated with other risk factors, in particular the market, just the market factor, and maybe even, you know, kind of less good, if you want, for investors in Bitcoin, is that most of the correlation actually is directional. So it's correlation on the downside. When the market crashed, Bitcoin crashes with it, right? And so as a hedge or as a store of value, this is truly not as an attractive feature of a potential new asset class. Yeah. And then let me just mention, as a, you know, kind of another thing that many people have pointed out, is that over the last 10 years, Bitcoin had a very attractive looking Sharpe ratio. But if you think about, you know, kind of where did this Sharpe ratio come from? Most of that Sharpe ratio actually came from the fact that there was still lots of people adopting Bitcoin, right? There was new flow of new capital and new people into that quote unquote new asset class or new currency, right? But you know, that's not a sustainable Sharpe ratio, right? Because we want to think about the true Sharpe ratio of an asset in steady state, right? Where would it come from in Bitcoin, given that Bitcoin is not a productive, you know, kind of not a productive asset at best, right? It would grow with the economy, or it would grow from, you know, kind of the overall growth once everyone who wants to adopt Bitcoin has already adopted Bitcoin. Yeah. So this is just why I'm showing you all this, right? So we just discussed this, is to say that at least the return properties that we now see, or that, you know, kind of have evolved on the blockchain, on crypto exchanges, right, don't make it look like a great store of value. Despite the fact, right, that it supposedly has become more widespread, exchanges have become better, at least some of them better regulated, and for sure have become much more liquid than in the past. Let me do the following. Let me stop here and give you guys how much break do you normally take? 10, 15 minutes, Mike?
10 minutes.
10 minutes. So let's do a 10-minute break. And after that, what I want to show you is actually, which is maybe more macro, show you some of the embedded systemic risks that I believe can come from basically what we know about miners and concentration of mining capacity, ownership concentration, and then just regulatory efforts on cryptocurrencies. Yeah.
All right, great. So let's take a break until 10:35 Eastern.
Perfect. Thank you.
Sorry, we're not recording yet. Okay.
Okay, perfect. Yeah. Okay, great. So as I was saying, so what I want to show you now is some of the new results that we can learn basically from understanding the Bitcoin blockchain flows, and then basically I want to talk about some of the main participants on the blockchain, miners and mining capacity concentration, and then ownership and concentration of ownership. But the reason why obviously we care about these type of participants is that well, maybe curiosity, just how they work, but more importantly, the type of impact that they can have on the integrity of this payment system. And so let me start by showing you the ownership concentration. So this is now based on being able to trace. Remember, I showed you kind of the fact that I can trace known identities such as exchanges, OTC brokers, payment processors, kind of ETF-like entities like Grayscale and their potential cold wallet and all these type of guys. And I can, for example, eliminate those type of large wallets that come from intermediaries, because we know that those type of wallets do not constitute ownership concentration, right? Because they are holding BTC on behalf of many, many investors. And so we obviously don't know how concentrated this is. Why this is important to point out is that if you look, obviously, given how much attention there has been paid on Bitcoin, right, there on many websites, people tout what is called the rich list, right? The rich list of BTC is the list of the largest wallets that you can see on the blockchain. But the issue is that a big fraction of the rich list is actually large addresses of intermediaries. And so, for example, the Binance cold wallet or the Coinbase cold wallet. And if you don't know that, you might think this is, kind of, I don't know, 5,000 BTC or 50,000 BTC held by an entity, when in fact it's on behalf of many people. But so we obviously are able to eliminate all this. And what we can look at is the ownership concentration among the type of holders that we can see are individual holders. How can we see this? We can see this by elimination. So obviously, I don't know who is behind it, right? But what I can rule out is that it's either an exchange, as I told you, any of these known entities. It's not a miner, it's not anything. So I have a list basically of traders that behave like individual traders do. And if I look at those guys, and I should say, by the way, I'm also throwing out the Bitcoin that are still controlled by the original entity that started Bitcoin, whatever, Satoshi Nakamoto is, right? So I even throw out those BTC addresses. What you see, though, is that the concentration of ownership even as of 2021 is extremely high. So this is now what I'm drawing for you here is in Q1 of 2021, the Bitcoin controlled, say, by the 1,000 largest addresses, right, 100,000 largest addresses that are not intermediaries. You can think of it this way, or that are individual entities. And, that's actually, if you think about it, quite stunning, right? It basically tells you that something like 100,000 addresses, potentially 100,000 people are controlling 8 million BTC, which at that time was about a bit less than half the BTC in circulation. And as we have now said many times before, that is at best a lower bound of concentration, because some of these guys might be the same person holding very large addresses, but never wanting to cluster them together, right? And that concentration actually has stayed, if I draw you the same thing in say 2018, it would look very similar, but not, and this is also something to point out, it's not because all these addresses are completely old and have never traded. So, that's not the case. So these are not somehow, addresses where somebody lost the wallet, the password, and now they still sitting around. That is not the case. But compare this, and I think this is why this is so stunning, compare this to the BTC held in the large addresses of intermediaries. So this is now the flip side of the ownership, right? This is the BTC held in exchanges, OTC brokers, blah, 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 right? The people that I ruled out in the first one. And here I'm just drawing you this over time, but look at it again as of beginning of 2021, you see that even though, yes, there has been, it seems, kind of more adoption of Bitcoin through these type of intermediaries. And again, right, we don't know who shifted, obviously, their Bitcoin ownership to these intermediaries, but many of it might be people holding very small amounts. But you can see in aggregate, that is about 5 million BTC, so more than 3 million BTC less than what about 100,000 addresses hold. Yeah, so why is this so important? It should tell you that there is a small set of entities that holds a very large stake in Bitcoin. We obviously don't know who they are, but that have either the opportunity to disrupt the ecosystem if they wanted to and chose to by, creating flows, and given what I told you about the price impact, right? They can rake a lot of havoc if they wanted to. But it also tells you that any price appreciation of Bitcoin, and with it, so for example, any large adoption of Bitcoin that might come from, changes in regulation, stand to help a very small fraction of people and a very small fraction of entities that we don't know who they are, right? So they are anonymous, they don't report to any regulatory entity or have to be beholden to the public good. I'll come back to this when we think about, what regulation should do, but it's really important to understand this, right? So this is not a situation where now millions of small investors are all holding, kind of the majority of BTC. And if BTC now became our means of storage, for example, kind of the wider public would gain much, right? In this direct effect, right? Who would stand to gain from the price appreciation? It's a very small set of entities. So, kind of that's one important thing I wanted to share with you. The second thing I want to share with you, given the work we've done on the blockchain, is how the mining capacity has evolved over the last decade, and in particular how it looks right now. So there has been a lot of attention paid to the mining pools. So as some of you might know, right, mining pools are, you could say, loose association or loose affiliation of miners that come together in a mining pool to provide co-insurance to each other. And the way it works is that, given the structure of the likelihood of hashing a Bitcoin, right? As an individual standalone miner, you have a lot of risk of whether you are the first or the second to solve the hashing puzzle, if you want. And that risk obviously leaves you with lots of income, kind of basically idiosyncratic risk. Now, to ensure for miners to insure themselves against this idiosyncratic risk, what many people have pointed out is that it's in the interest of miners to co-insure, meaning that they band together and pool their mining capacity, and then basically are paid based on the amount of mining capacity they provide to the pool, rather paid by whether they happen to be lucky to hash a particular Bitcoin at a given point in time or not, right? And that's what mining pools typically provide to the miners. And what people have been pointing out, I mean, this is more in the public debate, what has been raising a lot of eyebrows, is that if you look at the largest mining pools, the 7 largest mining pools, here basically all the way from, F2 pool over Ant pool / pool, BTC top, and so on, control about, control more than 60% of mining capacity. And on top of it, only one of the 7 largest mining pools is located outside of China. All the others are registered in China. But, so, right, that's all true. But that's actually, there's an interesting paper by Kong, He, and Lee that has, for example, pointed out that per se, that doesn't actually necessarily mean much, because mining pools are not miners. And for example, what, Kong and co-authors point out is that the risk sharing that the miners achieve within a pool, they can also achieve, a large miner can achieve this across pools, meaning as long as the payment, the mechanism of payment, right, has this feature of insurance, meaning you get paid for the hashing capacity you bring to the pool rather than just whether you luckily happen to mine something. It doesn't matter as a large miner that you go with one pool. You might actually want to diversify across many pools, or you might at any point in time be able to pull your mining capacity from one pool to another, right? And what actually that paper very interestingly point out, right? It's absolutely not necessary that pools will concentrate and centralize and then dominate the blockchain, absent some firm-specific capital that might give some mining pools an advantage. And Bitmain, people have said, for example, Bitmain, which is a provider of the main hardware, mining hardware, and is also affiliated with Antpool, might be a miner who has maybe, this type of firm-specific capital, but it's not clear that the other pools necessarily do. And actually what Kong here and Lee also point out that is normally you would be in a situation where the larger pools actually grow more slowly. And therefore, it's not clear, right, that the concentration of mining pools really is what we need to be concerned about. What we should be concerned about is if there's concentration of miners and the underlying miners. And that's kind of what I want to show you now, that we are able, because we can trace the Coinbase award from the pool to the miners, we can actually look at it, in the spirit, say, of this paper, how concentrated is the miners belonging to pools, and actually also how much diversification do the miners engage in across pools. Now, let me say one thing that also, the Kong et al. Paper points this out, and some other people have pointed this out too. It is true, though, that, of course, this type of cross insurance that pools provide to miners is good for the miners. It has the potential, if you want, negative externality, right? That by making the global mining capacity grow exponentially, right, it makes mining cheaper, and with it obviously has potentially, made it more competitive, and therefore has drawn even more capacity or resources into this competitive mining. That's obviously not something that I can see here or that I will be debating, but I'll show you some interesting facts. So just for you to have an understanding of what do I mean, right, with this tracing of Coinbase rewards to miners. So think about, right, this is Antpool, one of the largest pool. It's Chinese. It is registered in China, right? Now, what does Antpool do? What you can see on the blockchain is that Antpool has an address where it receives the Coinbase reward. Just to be clear, on the blockchain, the Coinbase is like, the Bitcoin that is issued when the miner verifies the block. Now, that Bitcoin yeah, sits in that address, but that doesn't do anyone good, right? So now AntPool needs to distribute those BTC it receives on behalf of its miners to the underlying miners. And the way they do this, and this was, kind of painful to no extent, but I will save you that and just give you the intuition, of course, is what we needed to do on the blockchain then, because all these transactions, of course, are on the blockchain, is to figure out how does it do that distribution? Because remember what I told you about the oddity of how stuff is accounted on the blockchain? What they don't do is they say, oh, we have this one address here, and now here are my 1,700 miners that I interact with every day or every week, and let me pay them all out from this one address. They don't do that. What they do is basically they have affiliated with it kind of a set of addresses where they collect rewards and hold them for some time. Part of the reason is actually that most mining pools do a thing where instead of sending you every half Satoshi, or not half Satoshi, let's say 3 Satoshi every, kind of couple of hours, what they do is they say, we accumulate for you, the miner, X Bitcoins before we distribute them. And so they, don't distribute every day. Sometimes they even do for smaller miners only once a week or once every 3 days. So they hold the Bitcoin in these reward collection addresses. From these addresses, they have basically reward distribution addresses through which the Bitcoin flows that then belongs to individual miners. And, kind of through tracing this flow, the periodicity of it, the frequency of it, and the amounts, right? We can then identify the layer of individual miners that work with AntPool. And then we can do the same thing for Slashpool and BTC Top and all these guys, yeah? Now, the network might look slightly different because they don't all behave the same way. And that's actually where a lot of the work came in to be able to do this. I will, kind of not bore you with this, but you understand now, right? When I talk about miners, I mean the individual entities that come together to the mining pool and are providing the hashing capacity that belongs to the pool. So first, I think my video froze, but can you guys still see my slides? Yeah, okay, good. That's actually the only thing that matters. So the one thing I want to show you is that we do a pretty good job in actually tracing all the Coinbase rewards from the, the Coinbase address, so to speak, from the reward receiving address down to the miners. So my, well, obviously the blue line here is the 100% of Bitcoins that were mined in a given week. And then I show you, right, the red line here are the rewards that are mined by the pools that I can trace, because we don't trace the extremely tiny pools. We only trace the 25 largest pools, but, kind of, as you can see, right, these 25 largest pools are almost 100% of mining capacity. And then I show you the green line here is the amount of Bitcoin of these mining pools that I am tracing down to the miner. And you see, kind of early on, we were not doing such a good job. I mean, part of the reason is that we didn't go back that fast. So you can, in a way, think of since 2015, we actually do a pretty good job, right? So we basically track most of the Coinbase rewards. And I should tell you, not that you are maybe even so interested in this, but this little blip here where it looks like we're breaking down is just that actually we can see this too, but this is just one big miner, which is kind of a private miner, which we had left out, but we now add it in. So we basically, right, we're tracing almost 100% of the mine. So this is important, right? Because it says that I can show you now how concentrated are the miners underlying the different mining pools. And here you should start getting a bit worried. At least I do. So let me show you, right? This is, remember, I mean, pre-2016, don't, kind of, this is probably not, our data not so good, but, kind of say starting from the middle of 2016 or 2017, we basically, kind of trace 100% of everything. And what do you see, right? What you see, and this is, through to June of 2021. So if you take, say, the blue line here, what this is saying is I'm tracking for you the number of miners that it would take to have 51% of the total mining capacity in the system. So it's in the system, it's not among my miners, right? That's important. So, and what you can see is basically, yes, in times when the price of Bitcoin is high, it was, in the middle of beginning of 2018, these were about 265 miners, right? And in 2020, when the price spiked in the second half of 2020, it was a bit less than 200. But look what happens in times when the price of BTC drops. Even in, kind of the beginning of 2021, right? Fewer than 50 miners, not mining pools, miners, control 50% of the hashing capacity. And remember what we've said, right? This is mining addresses. This is a lower bound on concentration, because it's very possible that one entity can hold several of these addresses. And so it might be even more concentrated than that. And you can see, right, if you look at the top 40% of hashing capacity, you see how skewed the concentration also is, because less than 25 miners make up 40% of hashing capacity. So that's actually starting to be very concentrated. And this is even true. In fact, kind of some people, kind of Bitcoin insiders, even Coinbase itself has tried to create incentives for miners to come in, especially US-based miners to come into mining, but that has not been very successful. The reason is that in some places in this world, electricity is still heavily subsidized, and lots of miners seem to be locating there. I'll show you some about this in a second. The other thing, this is just, to go back to the Kong et al. Paper. So first of all, right, mining capacity is quite concentrated, not just mining pool capacity. But remember what Kong et al. Also pointed out is that miners, the relationship between miners and mining pools also depends on the fact, or depends on how easy it is for miners to switch between mining pools. Sorry, in fact, of course, many people have pointed out that technologically, it's totally easy to switch between mining pools. There's no problem at all. But maybe in terms of contracting, or, kind of some mining pools like Ant Pool, because it's tied to Bitmain, kind of even have, more control over the Bitcoin protocol. So you might not want to piss them off, things like that, that might affect the relative bargaining power between mining pools and miners. But what I want to show you is actually, at least in what we can see, it looks like especially large miners diversify across pools. So what Kong et al. Pointed out, rightfully so, does seem to play itself out in the data, which is that especially large miners, so when I say the blue line here, this is miners that belong to that are basically the 1% largest concentration of miners. So the miners above the 99th percentile, let me say it this way, right? Those miners, about 40% of them on average, and early on, and then recently maybe more, 30% of them, actually diversify across pools. And then smallish miners, so the gray line here, right, is miners that belong to the lower half of mining capacity concentration, they are not so concentrated. But maybe we don't care so much about them, right? So this is basically reconfirming this intuition that we should care about mining capacity, not just pool capacity, because it seems that especially the large miners do diversify. And so this is diversify within a given point of time. They are working for at least 2 pools. We also see that miners switch from one pool to another and back and so on, right? But you see that even at a given point in time, there is concentration, which might make you at least pay attention to the fact that miners might have bargaining power and are important in the system, not just the pools. Okay, from this, let me, the other dimension of miners that I wanted to show you that has received a lot of attention is the geographical concentration. And in particular, right, people have pointed out that the mining pools are predominantly located in China, but the miners don't have to be. Now, because as we just said, right, they're not one for one the same thing. But given that I am now able to trace miners across the blockchain, I can also try to identify where those guys are located. Now, as you by now fully understand, right, obviously there's almost no guarantee that I can do this, because of course no miner walks around and says, I am a Beijing-based miner, look at me and this is my address, right? But so we have to be a bit trickier than that. And so there are 2 ways of how we can be tricky. One approach is to look at where miners cash out the BTC that they receive. And meaning on which exchanges do they cash out? Now, remember, they have BTC. They could cash out anywhere in the world if they wanted to, right? Because BTC is fungible. You can send it anywhere. Now, of course, if the exchange asks you for KYC norms, it might be difficult for a China-based miner or a Korea-based miner to cash out in the US, because citizens of China or Korea might not be allowed to open an account directly in the US. Right? On top of it, it might be the case that if you are a China-based miner, you don't really want dollar. You want your local currency yen, right? Or if you are a US-based miner, you don't want anything but dollar potentially, right? And so this idea kind of is one first approximation to see where most of the mining capacity is located. So when I do this, right, what I do here is I assign each miner's hashing volume to the region in which this miner cashes out most of its BTC. And in fact, what we normally find, right, is there's not much diversification. Meaning, very few miners, say, send some money to, say, Japanese affiliated exchanges, Chinese affiliated exchanges, and US affiliated exchanges. What you do see is that some miners send, say, to US affiliated exchanges and to tether-based exchanges. And what I call international here are these type of exchanges that are fully tether-based. In particular, think of the majority of this is literally Binance. And we do see, right, that there are many miners, the blue thing here are China-based miners based, on the classification of where they cash out from, right? And so you see that, interestingly, say until 2017, about 75% of mining capacity was cashing out in China-based exchanges. Since then, right, we see that China-affiliated exchanges such as Hyobi, Binchin, and so on, right, have dropped to more like 40–45%, but in particular, Binance seem to have taken up a lot of the slack. Now, right, but Binance, I don't know, it could be that a lot of Chinese mining capacity is cashing out there now, but it could also be obviously that the rest of the world really grew rapidly, and this thing is all US-based or Europe-based, right? So that from this picture, of course, is not necessarily clear. But what you do see, right, is that if you look, right, US-based miners, US and European miners are a very small fraction of, or a much smaller fraction of mining capacity. So this light blue thing here is, are exchanges outside of Europe, outside of China, and outside, obviously, of Binance and Tether, you know, and you can see that some of it is, you know, Japanese, Korean, and, you know, kind of Russian, South American, but that's obviously a small fraction. And then the dark red line is basically cashing out in places that we cannot identify. Yeah, but, you know, as you can see, right, that is a small fraction. Now, if you want to be critical, which you should, right, you could say, well, but in the end, given that Bitcoin really can be sent wherever, you know, it's not totally clear that this type of classification tells us exactly that, say, the blue bar, and in particular this green piece, green bin, which is Tether, whether this has anything to do with China. But, and this is kind of it's a neat thing, but not a good thing. You'll see in a second. But there is actually a way I can refine my classification. So how come? Because actually, what helps me classify Chinese miners much better is a really tragic incident in the Xinjiang province in China that happens in real mining. So this is not Bitcoin mining, this is coal mining. And what happened in Xinjiang in April of 2021 is that, so you should know this province is, you know, kind of has a lot of coal mining, and most of its energy generation comes from coal there. And in fact, it's indeed a province where electricity is heavily subsidized because they have such abundant coal. And so even before this incident, lots of bloggers and so on had said, right, that a lot of Chinese mining capacity is located in that province because of the energy subsidy. Now, what happened in April 17th of 2021 is that the Chinese government shut down energy supply in that entire province for a long weekend. And the reason is because one of the biggest mines got flooded and multiple people died and lots of miners were trapped in the mines. And while they were trying to get them out, and also because they couldn't get so many people out, right? They shut the mine, the physical mine, and they shut the energy supply. Now, if you think about it, right, that actually means it's an opportunity for me to identify true Bitcoin miners that are physically located in that province. Because unless your energy supply comes from this province, you have no reason to stop mining. And now I mean Bitcoin mining. In fact, if anything, right, it's the opposite. Actually, a lot of other mining capacity came online during that weekend because there was actually worldwide a drop of more than 35% of worldwide mining capacity because of that incident, right? Which already tells you how important miners in that area are. But more importantly, I can do better than that because remember, I can trace individual miners. And so I can show you, or I can identify miners that over that weekend, right, started, miners here meaning mining addresses, right, that dropped their capacity. And what you can see is basically, I have about 1,100 and something miners that had at least a drop of 20% in capacity and then came back online after the mine opened up again. I mean, the physical mine, and with it, the electricity supply. But because I wanted to be a bit more conservative, what I'll show you here is if I look at the miners who lost at least 50% of their capacity over that weekend, meaning that probably a very large fraction of their activity comes from that location, right? I have 804 large miners. And you know, that lost at least 50% of mining capacity during that weekend. Why do I do this? It's not, I'm not naive, right? This is not saying that all mining capacity in China is in Xinjiang, for sure not. But what it allows me to do is I can now look at miners for whom I know that they are truly China-based miners. Where do they cash out? So basically, I can verify if this assumption I'm making here, that if you cash out in a China-affiliated exchange or Binance, that you are much more likely to be Chinese. And look, this is exactly true, right? So if I look at, we call miners that have an address on an exchange directly, we call them exchange miners. And what you see, right, is that the majority of these miners, for whom I know because of this incidence that they are located in China, look where they cash out, right? They cash out basically almost half of their Bitcoin typically on Huobi, some of it on Binance, some of it on Oxex, Bitchain, exactly what you would think. Right? And then we have 200 independent miners. Just, you know, I don't want to bore you with this, but independent means that they do not immediately hold their BTC in the wallet of an exchange, but they have an independent address where they hold their BTC. And then once in a while, they send it to some exchange. And look, those guys, again, very similarly, right? Cash out in exactly those places. And so this is basically to say that given what I can do by tracing flows on the blockchain, I can now basically, I've shown you, right, that there's massive concentration of mining capacity in the hands of a few miners, but also that a lot of capacity of those large miners is physically located in China. Why do we care about that, if you think? I mean, so obviously the concentration per se, we should care about because the 51% attack obviously would invalidate the blockchain and would destroy the integrity, you know, of this payment system. But why should we care, right? Say that a majority of the mining capacity sits in China. The reason why we should care, and it's not necessary that it's China per se, right? But it basically means that this could create systemic risk for this whole payment system. Because if the local government, say the Chinese government, decided that it wants to crack down on mining activity per se, or it wants to disrupt the Bitcoin blockchain, it now physically could do it. Right? Because it could raid miners, it could make it illegal to engage in mining activity. And so actually, you know, this is not a good situation for this type of cryptocurrency to be in. So this leads me basically to the last part of what I wanted to talk to you about, which is given what I just showed you about, you know, the setup of the Bitcoin as a cryptocurrency, what does this mean if there was wider adoption of, say, Bitcoin as a store of value, or even, you know, kind of say as a speculative vehicle? And what I mean when I say wider adoption, what I mean with this is if the SEC or the Fed or the FTC allowed the regulated institutional investors to invest into cryptocurrencies. So what I mean with it, right, is if pension funds, mutual funds, ETFs were allowed to invest money of savers into this type of asset. So the first thing, right, that we should keep in mind is that if BTC literally became something like close to a payment mechanism, people have estimated that the total value of M1 in the G20 economies right now is something like $31 trillion. If even a part of this was replaced by cryptocurrencies, it basically means that this type of seigniorage benefit that currently is, if you want, goes toward the public, or at least, you know, kind of the government of individual countries, would now actually, that type of appreciation, right, would benefit a very concentrated small group of people who, as I showed you, hold a very large fraction of BTC. And as you know, I also told you before, right, though we don't know who these entities are, they clearly do not have any regulatory oversight, nor do they have, you know, any responsibility for the public good. Now, you might say, right, the Fed, or, you know, kind of the US Treasury has not always acted in the interest of all their citizens. That's probably true. And it has not always regulated the banking system in a way as we might like it to be, right? But at least there's public accountability, even if sometimes there's incompetence, right? So this is, but here that would not be the case, right? This price appreciation would go to people we don't know, and we don't know how they would act with this money. But maybe, you know, kind of from a perspective of financial stability, even more importantly, is obviously that we could be encountering massive systematic risk. Why do I say this? Because look, as I showed you, the verification protocol, or the hashing protocol on the blockchain, is dominated by unknown entities that are not necessarily representing the interest of society. And remember what we said, you know, kind of when we talked about the Budish paper, if these entities were only driven by economic incentives, you could say that maybe because of the continuation value of being a miner in the blockchain, it might prevent you from, you know, kind of from wanting to disrupt that kind of equilibrium. But that's totally not clear for entities that have utility from dimensions outside of financial utility, right? So if a state actor would enjoy disrupting, say, the Western financial system, maybe they're willing to spend a lot of money to acquire 51% of mining capacity and destabilize the system. Right? So this is something I think we want to be extremely careful about when thinking about, you know, kind of how much we want to rely on these type of non-permissioned anonymous blockchains. Now, finally, let me also say the following. This is something that I think several of you brought up before, which is, you know, kind of there is other type of malfeasance. I actually, personally, I have to say, you know, kind of the systemic risk actually worries me tremendously. The other thing that worries me tremendously is, if you think about it, right now, being illegal on the blockchain or doing illegal transactions in Bitcoin is actually relatively inconvenient. Why? Because if I have some money sitting in an account that, you know, kind of maybe comes from ransom payments or other illegal activities, where can I cash it out? I can go to an exchange, right? Mainly, basically, I can go to exchanges to cash against dollar, and a majority of the exchanges are now trying to, at least in a first degree, as I explained to you, right, to have some KYC norms, but I don't have a lot of stores I can go to buy something with BTC. So I have to maybe find a not so illegal friend who is willing to give me cash for my illegal ransom payments. But basically, right, you can see the places where I can turn ill-gotten gains into cash or other fiat currency is right now still somewhat limited. When there is wider adoption in many places, in many countries, in many unregulated hubs, it will become tougher and tougher to actually restrict the utilization of illegal and ill-gotten gains. And it will make it much cheaper to cash out. Because if I can now go and buy a Tesla or what have you with whatever BTC, and these type of stores don't have to enforce KYC norms, right? Then it will become really easy to actually use my illegal payments in many other places. And people, you know, actually when I listen to this kind of debate right now that's going on, people say, oh, the more we have wide adoptions, the easier it will be to trace. No, not at all. It will be exactly the opposite. This is exactly, by the way, it's like dollar. Cash is obviously also non-traceable. And because we can use it in many different places, even, right, illegal gangs and so on can use it. That's not a good feature of cash. That's a terrible feature of cash, right? So we don't need to now replicate the bad features of cash on steroids, because here we don't even have the physical constraint of having to transport that cash from your favorite collapsed country to another one. Yeah, so that's a problem. And then let me also say, the same is true for tax evasion. So this is actually something I wanted to come back to, right? As we said before, right now, for example, the IRS does not trace where your Bitcoin comes from. So if you declare that you held your Bitcoin in your account for X years and you had a certain appreciation on Coinbase, that's the capital gains tax you pay. But if you bought that BTC 5 years earlier and you just held it in your account and then send it to another Coinbase account, to a Coinbase, say, or Kraken account, and you don't declare that you owned it the 5 years before, you're not paying any capital gains tax on it. And if you're going to an exchange that doesn't even have KYC norms, again, you're not paying any capital gains on it. And if we allowed Bitcoin to be even a means of payment, it would become even more of a disaster, right? So, because if you think what it basically means is that we are giving a huge subsidy, a 24% subsidy to one asset class, when in all the others, we're making sure, to the best of the IRS ability, right, to actually enforce tax payments. And to be very honest, given what I just showed you about the commingling of accounts, the fact that I can separate the accounts, even my own addresses, in a way that makes it impossible for the IRS to prove that I held that account or I held that address before I send it to another address of mine that is a known address, makes it extremely difficult to actually enforce taxation rules without enforcing full transparency on the entire blockchain. But as soon as you do that, right, you're obviously destroying the reasons why most people who are really crypto enthusiasts are, you know, kind of in this. And then finally, and I will stop here, right, is what also worries me, and you can start seeing this in many places, is that, of course, it makes individual malfeasance and bribery and corruption even easier, right? Because you can now, in a very anonymous way, give, kind of dollars, Bitcoin, to corrupt politicians to reward them for whatever related transaction they do. In fact, what should make you very worried, right, is that you could in particular give them Bitcoin right now in order to convince them to change regulation in the favor of Bitcoin, because then they will benefit from the appreciation that they themselves, in a self-dealing way, have brought about, right? So those are probably not things we really want to subsidize right now and encourage even further, right? Especially, I'm not naming any names, but as you can see, many US politicians are now joining the boards of places like Binance and so on. And the mayor of Miami is now tweeting that you need to buy the dip. You want to really wonder how the mayor of Miami is suddenly a finance expert, right? So let me sum up here. So basically, where do we stand, right? As I showed you, it looks from everything that we have seen in terms of the utilization of Bitcoin on the Bitcoin blockchain, and also a growing amount of research on how Bitcoin is traded on exchanges, that it looks like mainly being a speculative asset rather than a store of value or even a transaction, having transaction property. I argued, right, that wider adoption will potentially have very destabilizing features for our financial system, and it will really depend on how the regulatory consensus moves forward in order to make sure that we are not going to be in 5 years bailing out all the idiots who invested in Bitcoin, their entire 401k, and then are sitting there with nothing left in their accounts. And I hope we're never going to get there, right? So, kind of that's something where obviously a lot will happen over the next few years, if not, months. Let me say one final thing, just, kind of to not end on a negative note. Right? I mean, Bitcoin obviously is not, as we said at the beginning, these type of proof of work, anonymous or pseudo-anonymous coins are not the only ones. There are many other type of coins, as we also discussed. One type of coin that obviously has gained a lot of attention are stable coins like Tether, but also, kind of central bank backed stable coins. And, kind of in the end, right, these type of stable coins are only as stable as they are runnable or non-runnable. So what because ultimately they potentially might want to engage in maturity and liquidity transformation without being regulated, say, with the lender of last resort, right? So what many people have promoted, which I think is very reasonable, is to have, for those type of stablecoin, a very narrow banking regulation, meaning, right, that any BTC or any tether of stablecoin is indeed tethered to a real dollar or a real asset that actually is equivalent to the stablecoin they issue. If that was the case, right, you understand, right? Then stablecoin is really nothing dramatic. All it is, it's a potentially more convenient payment system, similar to what mobile money is in Kenya or Tanzania, right? So the way mobile money works, say, kind of with Safaricom, is that they have to hold the amount of dollar in escrow that they are issuing in minutes in mobile money. And then, you're basically in a system of a very narrow banking system, which would prevent all these issues with runs against stable coins. Of course, right now, as you probably know, right, there are many stable coins in circulation that are not of this type, that are algorithmic, that are either based on beliefs or based on future price appreciation. And even Tether obviously has been accused of being untethered from the dollar in certain time periods, not, you know, kind of $0 behind it, but not 1 for 1, right? So this is something that, you know, kind of, again, a different type of regulation is possible. But remember, with these type of stable coins, which, you know, kind of do not need this type of decentralized verification of the payment system, of the transaction system, you know, kind of, it's much closer to something like a permission blockchain. The final thing I do want to say, which I find amazing, is that if you look at what's going on in payments right now, more generally beyond cryptocurrencies, right, from PayPal to Venmo to even, you know, kind of your bank now starting to actually transact in a more timely and, you know, kind of more fee conscious way, right? I do believe that without this type of competition, actually things wouldn't have moved as quickly as they have moved over the last decade. So you can say that the externality, or the positive externality on all of us, is probably that we have seen payment systems become more competitive. And the other thing is, hopefully we will see payment systems becoming much smarter, because the fact that we now can have, right, these type of public ledgers that allow you to do more than just send $1 from my account to Mike's account and then somebody else, but to trace it on, or maybe to restrict the use of the payment, right? Those are all things that might improve governance, but that also might make it actually, you know, that basically will determine many new use cases, C2C, I mean, consumer to consumer, but also business to consumer. So think of it, even things like, if I want to send money to my, I don't know, niece, but I don't want her to spend on certain type of things, or I only want her to spend in a certain type of periodicity, right? So you can say, okay, why do I have those stupid preferences? Let her spend when she wants, right? But if I do have these kind of preferences, I actually could now have much better ways of designing contracts. So I think, you know, there's definitely, right, we all might stand to gain a lot from having these new forms of ledgers in the economy. Rather than talking to you at the end about crypto trading across exchanges, let me release you guys. If those of you who are interested in crypto trading across exchanges, which is an unrelated topic, it's a topic that I find interesting, but you might not. You know, kind of, you can look at you know, some of my past work, but I stop here and I say thank you.
All right, thank you very much, Antoinette.
You're welcome.
Do you guys have any last minute questions, comments?
Thank you.
Cool. Thank you. Cool.
Thanks a lot, Antoinette.
Thank you. If there are no questions, I hope you have a nice rest of the summer before you all need to go back to our respective PhD programs. And at least I hope some of you are thinking of working on cryptocurrencies, especially in terms of regulatory issues and also competition with the broader payment system. Okay.
Thank you.
Thank you.
Again.
Thank you, guys. Take care. Are you in New York, Mike?
Yeah, I'm